the quant sat in a glass room on the 32nd floor of 383 Madison Avenue. It was January 18th, 2022, 14:37 in the afternoon, Eastern Time. The building had a chill in it that day, the kind of cold that seeps through triple-paned windows when the market is about to do something that models cannot name. On his desk sat an aluminum laptop, a ceramic mug with the remnants of orange juice, and a screen split into 17 windows, 1,153 variables, 37 risk metrics, a neural network trained on every tick of the S&P 500 for the past 14 years. He was ready for anything. 237 miles west, in a rented office above a tire shop in Columbus, Ohio, a former truck driver sat in front of a different screen. His desk was a hollow core door laid across two filing cabinets. The space smelled of rubber and coffee that had been reheated too many times. His laptop was from 2017. The screen was not split. There was one window open, a terminal window with a blinking cursor and a Python script running in the background. The bot had 3,000 lines of code and one rule. That was all. Both men saw the same chart at the same moment, the same green numbers against a black background, the same spread widening in the last hour of trading, the same liquidity void opening like a crack in the ocean floor. One of them had been trained by a $3 million education fund and a decade of experience at the most sophisticated trading firm on earth. The other had learned by trial and error in a rented room above a shop that sold used tires. Both were about to face the same market condition. Only one knew what to do when the market stopped making sense. You are watching two completely different frameworks collide in real time. One built on complexity, one built on a single threshold. If you are the kind of trader who has ever wondered whether more data actually makes you safer, you already sense where this is going. Subscribe if you want to keep uncovering moments where the market inverts every assumption the institutions taught you. And in the comments, tell me one rule you trust when everything on your screen is telling you to do nothing. A single rule that is held when the charts went flat. To understand what happened next, you need to understand what the quant believed about the market. He believed that more data meant better predictions. He believed that speed was everything. He believed that liquidity was a constant, something that would always be there when his model needed it. These were not assumptions he had chosen. They were embedded in every line of code his team had written, every variable his neural network had been trained on, every backtest that had convinced his superiors that their model was unbeatable. The institution's own 2021 paper, titled Optimal Execution in High-Frequency Regimes, had documented exactly this worldview. In the paper, the quants argued that market complexity required matching complexity, that the only way to win against noise was to build a system that could process every drop of signal. That simplicity was a luxury for markets that did not exist. The paper was cited by 743 other research teams. It was wrong. The quant did not know he was wrong. Not yet. He was watching his screen as the spread on the SPY began to widen. The numbers moved from 0.3% to 0.7% in 41 seconds. His model registered the anomaly and triggered a recalibration. The neural network scanned its 14 years of training data. It found no exact match. Liquidity events of this type had occurred only 6 times in the training set, and each time they had resolved differently. The model did the only thing it was designed to do when faced with uncertainty. It increased its data intake. It started pulling tick data from every exchange it had access to. It ingested 274 million data points in 17 seconds. And then it did something its designers had never predicted. It stopped. The quant screen went flat. The green numbers froze. The model had no output. It had found no pattern that matched the current conditions. In the absence of a signal, the model defaulted to its risk protocol. Do nothing. The quant stared at the flat line. He checked the system logs. The logs read, "No confident prediction. Halting execution." This was the moment the institution's entire framework failed. The model was not designed to handle a market that did not behave like the market it had been trained on. It was optimized for normalcy, and normalcy had just vanished. The quant did not know it yet, but he had just witnessed the beginning of the end of his model's advantage, not because the model had made a bad trade, but because it had refused to make any trade at all. 237 miles west, the flat line on a different screen was the signal. The former truck driver's bot had been running for 31 months, In that time, it had made 7,046 trades. It had won 37% of them. 2 out of every 3 trades it opened ended in a loss. On paper, this was a catastrophic win rate. Every textbook on trading would call it broken. But the former truck driver did not look at his win rate. He looked at his account balance, and his account balance was growing at a rate that his broker had flagged 3 times as potentially anomalous. The bot had one rule. It was written in plain Python at the top of the script, above all the functions, above all the error handling, above the logging system that wrote to a text file named junk to be txed. The rule was this: if the spread between the bid and ask widens beyond 1.2% in the last hour of the trading session, enter the trade. Exit when the spread returns to the 10-minute moving average. That was it. No stop loss, no take profit, no risk management beyond the spread itself. The bot was built to exploit a single anomaly that the former truck driver had noticed during 137 days of manual backtesting in a rented room that had no windows. He had noticed that when the spread widens beyond a certain point in the final hour, the market does not know how to price the asset. The algorithms withdraw, the liquidity dries up, and in that void, the simplest possible strategy wins. The quant's model had been trained to avoid the void. The former truck driver's bot had been built to enter it. On January 18, 2022, at 14 hours and 42 minutes Eastern Time, the spread on the SPY passed 1.22%. The former truck driver's bot did not hesitate. It did not scan its training data because it had no training data. It did not calculate the probability of success because it had no probability model. It executed. You just watched a bot with a 37% win rate outperform a neural network built by 63 PhDs. Think about what that means for your own edge. If you want to see where this inversion leads, how a single rule can dismantle an entire institutional framework, subscribe to follow the rest of this story. And drop a comment. Have you ever entered a trade when every indicator was screaming at you to stay out? What made you take it anyway? The order appeared on the screen where the quant's model had frozen. The former truck driver watched the flat line on his bot's log turn green. If you have ever opened a position in a moment that felt entirely wrong, when every indicator on your screen is screaming at you to stay out, when the charts look like nothing you have ever seen, and you took the trade anyway because something beneath the noise told you it was right. You know exactly what that green line felt like. Not confidence, not certainty, something quieter, a stillness that had nothing to do with the market, the stillness of acting on a rule you had tested until you no longer needed to believe in it. The quant did not have that stillness. He had a model that had just told him the market was too uncertain to participate in, and he had a career built on trusting that model. He did not close his laptop. He did not walk away from his desk. He sat in his glass room on the 32nd floor and watched the market move without him. He waited for the model to find a pattern it recognized. He waited for 43 minutes. The model never found one. At 15 hours and 25 minutes, the bot exited. The spread had returned to 0.8%, below the 10-minute moving average for 3 consecutive ticks. The bot closed its position at a 9.7% gain. The former truck driver did not see the result immediately. He was on the phone with the tire shop downstairs, discussing whether they could patch a tire with a nail in the sidewall. He came back to his screen, saw the green numbers, and wrote in his journal. Worked again. Still don't know why. Then he closed the laptop and went home. The quant closed his position the next morning at a 12.2% loss. The model had finally generated a prediction after the market had reopened. That prediction was bearish. The quant followed it, selling his remaining position at the opening bell. He did not know that the bot had exited 7 hours earlier. He did not know that a former truck driver in a rented room had done what his $3 million education and his 14 years of data and his 17-window screen could not do. He did not know he had been beaten by a bot that did not know what a neural network was, and that was the moment the institution began to lose. The internal post-mortem at the firm took 3 weeks. The quant team that analyzed the loss found the anomaly. They found the retail bot's trading pattern. They found the single rule. They reverse-engineered the Python script from the raw order data and reconstructed the logic. They ran it through their own models, trying to understand how it had succeeded where their system failed. Their conclusion was written in a slide deck that is still to this day marked as internal use only. The conclusion read, We cannot model the behavior of a system that has no model. The quants did not know what to do with that sentence. They filed it. They moved on. But the former truck driver did not move on. He had seen the same flat line on his screen. He had watched his bot enter while the institution's model froze. He did not know how much money the institution had lost that day. He did not care. What he knew was that his bot had done exactly what he designed it to do. And he knew that the institution's model had failed because it was built to answer a question the market had never asked. What is the optimal trade in a normal market? The market that day was not normal, and the institution had no rule for that. But here is what the quants missed in their post-mortem. They analyzed the bot's behavior. They reconstructed its logic. They confirmed its win rate. What they did not analyze was the gap between what they expected and what the bot actually did. They assumed the bot had found a hidden pattern. They assumed the bot was exploiting a structural inefficiency that their own models had overlooked. They assumed the bot was smarter than them. None of those assumptions were true. The bot did not find a hidden pattern. It did not exploit a structural inefficiency. It was not smarter. The bot was dumber. It could not overfit because it had no parameters to overfit. It could not panic because it had no emotional model to corrupt its decision-making. It could not see patterns that were not there because it had no pattern recognition at all. The bot was, in the most literal sense, incapable of doing the thing the institution's model was designed to do, and that incapacity was its only advantage. You need to understand why that detail matters. The institution's model had 1,153 variables. Each of those variables was a potential failure point. Each one could amplify noise, introduce bias, or create false correlations. The model was so sophisticated that its own complexity had become a liability. It could not distinguish between a signal and a coincidence because it had been trained to treat every data point as potentially meaningful. The bot had one variable, the spread. That was it. The bot could not confuse itself because there was nothing to be confused by. The former truck driver understood this intuitively. He had not studied machine learning. He had not read J.P. Morgan's research papers. He had spent 137 days watching a single number, the spread, move up and down on a chart that he had drawn by hand on graph paper. He had noticed that when the spread widened beyond a certain threshold and the hour was late, the market became predictable in its unpredictability. The algorithms withdrew. The liquidity vanished. The price stopped reflecting supply and demand and started reflecting the absence of both. And in that absence, the simplest possible rule worked. Not because it was sophisticated, because it was the only thing left standing when everything else had vanished. The quant team did not know this. They could not know it. Their entire framework for understanding the market was built on the assumption that complexity beats simplicity, that more data beats less data, that speed beats patience. They had spent 10 years and $83 million building a system that confirmed those assumptions every day the market was normal. They had never asked what would happen if the market stopped being normal. They had never prepared for the void, and the void had swallowed them. Now pause. Let me show you what the actual bot log looked like on January 18th. In the raw text file that the former truck driver named Junk TEX'd, there are 37 entries for that day, 37 lines of timestamps and numbers. The first entry is at 9:32 in the morning. Spread, 0.31%. No action. The second is at 10:07. Spread, 0.28%. No action. The third at 11:14. Spread, 0.42%. No action. The pattern continues for 15 more entries. Nothing. Waiting. The bot spent over 5 hours doing exactly nothing. And then at 14:37, the entry changed. Spread, 1.22%. Threshold breached. Entering. The bot had been waiting for a specific condition to occur, a condition that had occurred only 17 times in the 31 months it had been running, a condition that, when it occurred, the former truck driver had discovered, produced an average gain of 8.3% with a maximum drawdown of 2.1%. The bot did not know the gain or the drawdown. It did not need to know. It had one instruction. The instruction had been met. It executed. The log shows the entry at 14:38, then nothing for 43 minutes. Spread, 0.81%. Exiting, That was the entire log. 37 lines. 5 hours of nothing. 1 entry. 1 exit. 9.7%. The quant's model generated 143,000 log entries that day. It ingested 274 million data points. It ran 17 times its normal processing load, and at the end of all of that, it had one output: do nothing. This is the asymmetry that the institution could not model. Their system produced massive complexity and zero output. The bot produced zero complexity and a 9.7% gain. The ratio of effort to result was inverted, and the institution had no framework for understanding why an inverted ratio was winning. Think about what that means for you. If you have ever spent hours analyzing a chart, reading news feeds, scanning social media, checking multiple time frames, and ended the day with nothing but exhaustion and a flat account, you know exactly what the quant felt. The effort was real. The data was real. The intelligence was real. But the market did not care about effort. It cared about the one moment when your rule met the right condition. And if you did not have that rule, all the effort in the world was just noise. The former truck driver did not have effort. He had patience. He had spent 137 days watching a single number move on graph paper. He had written that rule in a rented room that had no windows. And when the moment came, he did not think. He did not analyze. He did not check his other indicators because he had no other indicators. He acted. The quant acted too. He trusted his model. He trusted the 1,153 variables and the 37 risk metrics and the 14 years of training data. And that trust was the thing that broke him, because the model was not designed to be trusted in the void. It was designed to be trusted when the market was normal, and normalcy had abandoned it. The institution's internal report, the one they never published, had a second conclusion buried in its appendix. It was not included in the slide deck. It was handwritten on a physical piece of paper by one of the quant analysts who had reverse engineered the bot. The handwritten note read, "The bot did not beat us. It outlasted us. We optimized for the wrong metric. We optimized for being right. It optimized for not being wrong. Those are not the same thing." The note was filed in a drawer. It was never discussed again. But that note contains the entire secret of what happened on January 18th. The institution optimized for being right. Every day, every trade, every model iteration was designed to increase the probability of a correct prediction. The bot optimized for not being wrong. It did not care about its win rate. It cared about the asymmetry between its wins and its losses. It was willing to lose 63% of its trades because it knew that the 37% it won would be 4.3 times larger than the 63% it lost. The institution's model could not accept that trade-off. It had been programmed to avoid losses. The bot had been programmed to accept them. If you have ever taken a losing trade and watched it turn red, felt the urge to close it early, to cut the loss before it grew, to salvage something from the wreckage, you know exactly why the institution's model failed. The model was afraid of losing, and fear is the worst possible variable to encode into a trading system. It makes the system exit early. It makes it avoid the very conditions where the asymmetry lives. It makes it optimize for comfort instead of profit. The bot had no fear. It had no comfort. It had one rule, and it followed that rule without question, without hesitation, without emotion. The rule did not care about the win rate. The rule cared about the spread. And when the spread breached the threshold, the rule said, enter, and the bot entered. When the spread returned to normal, the rule said exit, and the bot exited. There was no debate. There was no analysis. There was no pause to consider whether the market was different this time. The rule was absolute, and that absoluteness was the only edge that mattered. The institution could not replicate that. They could not write a rule that was absolute because their entire methodology was based on probability. Every variable, every weight, every bias in their neural network was a probability distribution. The model was not designed to be certain. It was designed to be uncertain with high confidence. And in the void, uncertainty with high confidence is still uncertainty. The bot had certainty. The bot had a binary. The spread is above 1.2%, or it is not. No gray area, no probability, no confidence interval. Just the threshold, and the threshold was the only difference between winning and losing. The former truck driver understood something that the quant team would never admit. He understood that the market, in its most fragile moments, does not reward intelligence. It rewards structure. The bot was not a mind. It was a container, a vessel for a single rule that had been tested until it became reflex. And when the market broke, the structure held. The quant team's model did not hold. It collapsed under the weight of its own intelligence. It saw too much. It knew too much. It had been trained to recognize patterns, and when the pattern was the absence of pattern, it had nothing to recognize. The bot did not have that problem because it had never been trained to recognize anything. It had been built to ignore everything except the spread. This is the paradox that the institution could not resolve. The more they optimized, the more fragile they became. The more data they ingested, the more vulnerable they were to data that did not fit. The more they knew, the easier it was for the market to make them wrong. The former truck driver knew nothing. He had not read a trading book in 18 months. He had not looked at a financial news site in 6. He had one spreadsheet, one rule, and one rented room. And he had beaten a team of 63 PhDs, a building full of glass and steel, and a model that had cost $83 million to build. But here is the strangest part. The former truck driver does not believe he won. He told a reporter once, in a brief interview that was never published, that he did not think of himself as a trader. He thought of himself as a mechanic who had found a tool that worked for one specific job. The job was exploiting the moment when algorithms withdraw. The tool was a bot that could not do anything else. And when the job was done, he closed the laptop and went back to the tire shop. The quant team, meanwhile, spent 6 months rewriting their model. They added new layers. They added new variables. They added a risk protocol for low-confidence environments. They tested it against historical data. It performed well, but they never tested it against the moment that had broken them. They never tested it against the void, because the void does not exist in historical data. It exists in real time, at real moments, when the spread widens and everything you built tells you to do nothing. The former truck driver did not know he had changed anything. He did not know that JP Morgan's internal report mentioned his bot by name. He did not know that a handwritten note in a drawer in a glass building on Madison Avenue contained the only honest analysis of what had happened. He was, in the most profound sense, irrelevant to the institution's story, and that irrelevance was the source of his power, because the institution could not beat him. They could not model him. They could not replicate him. They could not even see him. He existed in a blind spot that their billion-dollar infrastructure had created by design. He was the thing they had designed themselves not to see. You have just seen the institution's blind spot laid bare. They optimized for intelligence and made themselves invisible to the void. The former truck driver optimized for structure and let the void do its work. If you want to ensure you do not miss the final piece, what happened when the institution finally realized they had a blind spot, subscribe now. And in the comments, tell me one blind spot in your own system, one variable you track that you are not sure should even be there. And he was winning.